Welcome back to the KDI Wealth Alchemist. And today we're going to look at some of the most powerful tax and investment planning tools around. Some of them might be fairly basic and some fairly advanced that you might not have heard of. We're going to look at DAFs, Qualified Charitable Distributions, tax loss harvesting, and potentially even some backdoor Roth IRAs, as well as a few other avenues. Shane?
Thanks, Dylan, for the intro. So as Dylan mentioned, we're going to go through some tax strategies and even some different types of investments that may have a little bit more tax efficiency to them or tax-free interest like municipals. Looking forward to the conversation today. We're going to take some deep dives or stay pretty high level on some of the tax strategy. But of course, if there's any questions that may come up as you watch this or any curiosity, do not hesitate to reach out.
Perfect. Probably one of the most powerful ones that we see a lot of clients overlook are qualified charitable distributions, or QCDs. A few key points about those. It's a direct transfer from your IRA to a 501c3 charity, and you can do that starting at age 70 and a half. It satisfies your required minimum distribution, and it also helps avoid taxable income. Shane, why would you consider a QCD?
Yeah, lots of reasons to consider a QCD. And where we normally see the most here is we have clients who already have near and dear charities to their heart. They're already giving either on a monthly basis or on a yearly basis from their bank accounts directly. A lot of these 501c3s and charities have gotten really good at getting you set up on a subscription type basis, which is all well and dandy up until the point you're 70 and a half. Because at that point, every cent that comes out of your bank account has already been taxed at some point in time. When you have IRAs or 401ks sitting there with pre-tax dollars sitting in them, what a qualified charitable distribution will do for you is it allows you to take that pre-tax dollar and give it directly to the charity, as you already are doing directly from your bank account, but you take it and give it directly to the charity. It will, at 73, if you have an RMD, it will satisfy your RMD. So it'll count as your RMD, allow you to give, not be taxable to you, give you the charitable deduction, and not be taxable to the charitable organization. So it is a win-win-win in regards to giving directly from your IRA to a 501c3. At 70 and a half, you're allowed to give. Now, again, no RMDs there, but it does help get money out of a pre-tax bucket. If you know you're going to have bigger tax consequences down the road, when you have RMDs start to kick in, to start giving directly from there and save some of that tax, after-tax dollars that are sitting in your bank account.
It's a really powerful tool. And what's the maximum amount that you could give each year if you wanted to?
At 70 and a half, up to 110,000. So you talk about a substantial amount of giving that you can do on a year-by-year basis. We have some clients that give, especially when they hit the age of 73 or the RMD age, they'll give their entire RMD to a 501c3 or charity. It'll satisfy the RMD, not count as taxable income to them, and not count towards taxable income to the charity organization itself, which is a beautiful thing. So highly recommend considering QCDs. And as I mentioned earlier, what I come across most frequently is clients are already doing the giving. If we just switch the account, we can make you more tax efficient.
Exactly. A lot of the topics you're either already doing, or it's just a way that we can provide a little extra return besides just an investment return. It really is a tax alpha where we provide that benefit for you. So running into that annual maximum, our next segment was donor advised funds, potentially for years that you want to front load some charitable giving for tax reasons. So again, why would someone use a DAF or a donor advised fund versus giving directly to a charity or giving year by year?
Yeah, two main reasons. And again, Dylan, you're just as familiar with this as we've had a couple of clients in years past and even this last year come across where either they're going to have a business distribution, maybe they have a non-qualified plan that's paying them out all at once, the money that they had deferred for years, and they're going to have a big income tax liability. If they're already a charitable giver or already strategizing in how they can be either more philanthropic and giving more, but also want to be tax savvy, if you use a DAF, the two main reasons why you would is you can, one, you have an ability to put a significant amount of funds into a DAF in one single year. So remove that cap of 110 grand like you would see in as a QCD or something like that, but have the ability to put a big chunk into it and then also have the ability to be very intentional and deliberate with how you give. It doesn't all have to be given within a year. And now you have ultimately an account that you can give year by year, pick and choose the charities, and be very mindful and thoughtful on how you give. Would you add anything to that, Dylan?
I'd say another portion there is those funds continue to grow and be invested as you decide to give them those grants and those donations out year by year. It's still flexible. If you want to pause giving or change charities that you're giving to, it's certainly an option, and you still have a lot of freedom around that. And a lot of times we see those funds grow and be a great tool.
Yeah, you watch clients who ultimately get to give significantly more than what they contributed because of the growth inside that DAF. So, depending on the investment strategy that's deployed with the DAF and the frequency of giving, you'll see that you may actually be able to maximize your giving even further, and just purely based on the investment strategy inside of it.
The next one, likely, if you're already working with us, you'll have heard us talk about this in our annual strategy meetings, but tax loss harvesting, it's a little more basic strategy most of you guys will likely have heard of. Shane, can you explain the basics?
The basics of tax loss harvesting is if at any point in time we have a position in a non-retirement account that has taken a loss. I'll give you an example. Take buying Apple at $100 a share, hypothetically, and it falling to $70 a share. You have a $30 per share loss. If we went and were to sell it at that time, it would realize that loss and ultimately make it a reportable loss, as long as we avoid, one thing you want to always make sure you avoid with buying and selling is wash sale rules. So as long as we don't go out and buy Apple or a very similar stock within the next 30 days, we could avoid the wash sale rule and then capitalize and take that loss and be able to use it for tax purposes. The reason why this can be such a significant tool, or the way it can be used by your advisor, is that most are not aware that markets have a plus minus 20% drawback at some point in time in the year. So even though most years end up positive, if you're looking at the major indices like the S&P, the NASDAQ, the Russell, the Dow Jones, you will find that at some point in time in that year, the market has had a major drawback. Let's reference 2025, for example, where in March and April, we saw 20+% drawdown in the markets. If at that point in time, your advisor was able to sell and ultimately capture some of those losses and get that money reinvested differently, at the same time, you have not only been able to capture losses, but also still continue to partake in a year where the market did double-digit returns by the end of the year. So it can be a savvy tax strategy if your advisor does it correctly.
And there's two other use cases that I see all the time is a client will transfer in with an existing account that has, let's say, SPY that's very appreciated, has a really low basis. It's done great. In the last 3 years, the S&P's done double-digit returns. So likely most of those, if they're in a non-retirement account, you have some tax implications if you're going to sell that position. So if you need some liquidity, we'll look at those positions and potentially some other ones that might have losses, and we can pair that gain and loss and essentially wipe out any tax liability you have. So it makes it a really tax efficient way to get some liquidity back in your accounts. And then building off of that, when you have non-retirement accounts that we're investing, and over time, we'll do this year over year over year, so that those positions that we typically see great growth in 10, 15 years down the road, you're not sitting there with the position that you can't sell without a big tax bill. So it really helps future proof your portfolio, and it's the returns you don't really see off the top.
Actually, Dylan, maybe you want to add on to that and talk through why we might tax harvest even in years where we don't have realized gains to offset, and the power of tax harvesting and what the CPA or EA can do with tax harvest losses year over year.
Those losses do carry over. You can offset about $3,000 a year of ordinary income. Let's say you took a $20,000 loss. We can spread that out a little over 6 years currently. And we like options in investing and keeping our avenues open. So if we realize those losses at the time we can, it really gives us flexibility down the road that, hey, let's say a certain expense pops up and you need a quick few dollars you weren't expecting, we can reach those funds without having to hold some back for a tax bill. So being opportunistic and planning down the road gives us options that we might not have if we had no reason to sell at first glance. But when we look a little deeper, most of the time it makes sense to realize some of those losses. One of the next portions is a backdoor Roth IRA. Shane, fill us in on the basics. I know there's been a lot of talk on the internet and social media over the last 10 years. So there's a lot of misconceptions out there and pitfalls to avoid. Can you kind of walk us through the basic strategy and then we'll talk through some of the things you might look to avoid?
Yeah, looking back over the last decade, 2022 and 2023 are probably the closest it became to getting taken off the table. It's something that Congress and legislation has been put forth where they're looking at possibly trying to get rid of, I guess you could call it a loophole, but it's a strategy that's used nationwide across the board for high income earners. And here's the basics of it, right? So depending on how much you earn, either married filing jointly or single, if you hit over a certain threshold, you do not qualify to contribute to a Roth IRA directly, right? You make too much money, you don't qualify. You cannot add money into a Roth IRA on an annual basis because you make too much, per the IRS guidelines. Then there's also another threshold on the traditional IRA side where if you make too much, you don't get the IRA deduction on the traditional IRA side. You don't get to write it off, the deduction for tax purposes. So you will find clients, if they don't qualify to contribute directly to a Roth IRA, advisors recommend where you have the ability to put money directly into a traditional IRA. Even if you don't get the deduction, the whole goal is to put money into that traditional IRA, which you're allowed to. There's no income limit for you to just put money into a traditional IRA. There's a lot of reasons why you wouldn't just do that, but there's no income limit to it. You put it in there, even if you're not going to get a deduction, and immediately convert it over to a Roth. So the strategy is same day or one day put it in the traditional and immediately convert it over to the Roth IRA. It's considered a Roth conversion. There's no taxability to it. The money went right into a traditional, converted over to a Roth. There's no taxation to be considered there. It is considered a true backdoor Roth conversion, is how it works. There are some pitfalls though. If you have existing traditional IRAs, you've got to be careful. So this is one we'd recommend you probably consult with your CPA or EA if you're looking to do it out on your own. Of course, if you're working with an advisor or you're working with us, this is something we can definitely discuss and talk through maybe some of the nuances you may not know surrounding what a backdoor Roth conversion looks like. But as of 2026, this is live and well as a strategy to be deployed.
Really makes it accessible, the power of that Roth and the tax deferral down the road. It really helps those clients that are high earners take advantage of that.
Yeah.
Mhm.
Yeah. And I would say more and more, again, if you don't have the option or you're already utilizing the option fully to one of your employer plans, it's definitely a nice little addition strategy to get another 7 to 8 grand into a Roth bucket if you're in a high income bracket or in your high earning years. So definitely recommended, but definitely would consult with your financial professional or tax professional.
Mhm. One other one that has seen some changes recently, and it's a smaller tax benefit, but 529 plan deductions for when you donate to a beneficiary through a 529 plan. We've seen some changes with Roth rules where you
Yeah.
can now convert some of those 529 funds with some parameters and guidelines around it into a Roth. So it's opened up some flexibility for those beneficiaries down the road. And remiss if we didn't mention it. The small tax benefit is about a $4,000 deduction for married filing jointly, depending on your state. So there's definitely some nuances there. But Shane, what are some things that you might look out for there?
Yeah. We could probably spend an entire session, a podcast on 529s. There's so much to unpack with 529s, and a lot of it has to do with how legislation has changed how 529s can behave and operate. Early on, people would avoid 529s because they were a little bit more restrictive. They had to be used on education and very specific types of education. And what we've seen over the last decade, or even over the last 5 years, a lot of the rules be adjusted and modified to be much more inclusive of your private and charter schools at younger years, where they could be used for elementary to high school to where going to private school, you're able to use 529s for, and again, for those specific schools. And of course, there's some parameters and there's a list from the government, a bit depending on accreditation. But even at a college level, There's significantly more colleges included in the list today than there were originally. More trade schools are getting more involved in the 529 side of things. And then the other piece, which is why I think a lot of people avoided 529s to start, is you have your brand new baby or a 5-year-old grandson or granddaughter, and you don't know what their future holds for them. So you're afraid to put X amount of dollars into a 529 if they're not going to go to college. Well, some of the recent legislation changes and what you alluded to, Dylan, with 529s is that there's now the ability to convert a specific amount of funds from 529 over to Roth IRAs, which gives me more peace of mind, even for my kids' 529s. It's like, hey, I don't know how much they will use on college, but I know that I'll be able to convert some of it to retirement funds for them long term.
Mm-hmm.
One other piece, again, tax benefits, and this is, of course, all about tax. I know I went on a little diatribe just about 529s, but in regards to tax, of course, if that money is contributed and used for education, it gets tax-free growth and on all the earnings. And so that's the benefit to the user. And the whole purpose of the 529 is it gets to grow and be tax-free down the road for college education. If you do end up having to do the Roth conversion from the 529 over to the Roth IRA, right, we get to convert those funds and move them into a tax-free bucket, which is just as beneficial. And then last but not least is whichever donor, and again, we live in Arizona, of course, so speaking about Arizona in this specific segment is that if you give up to $4,000 and get a state tax deduction for that giving, and that's per beneficiary. And that would be if, let's say, for example, I have a 529 for my son, and Dylan, you wanted to give to it because you're super generous and love my sons, and you would get that state tax deduction for your donation as well.
Perfect. We see a lot of family giving that they don't realize they can take that deduction. And if you're trying to convince some family or friends to donate to it, it might be a little fun piece to let them know. Might help them out on
Right.
their taxes.
That's a good
So,
point.
and then switching gears back to your taxable accounts, especially for our high earning individuals and clients. When we look at fixed income, there's a taxable suite of funds, bonds, corporate bonds, high yield bonds, all sorts of things. There's a real whole smorgasbord out there. But there's also a lot of tax advantaged income options that we can take advantage of. And there's a little bit of math involved to figure out which one would be best for you and based on what you're making. Shane, when do you think that starts to come into play when you might want to consider tax advantaged income in your taxable accounts versus taxable income?
Yeah, that's a good question. When I'm working with individuals, usually what I'm looking at there, Dylan, is what income we're running through their tax return from the year prior. What income tax bracket do they sit in? Are they on the threshold of bumping into another tax bracket? The idea is like, are we in a tax bracket today that we're likely not going to be in the future, right? When we're retired, are we going to be in a tax bracket that is much lower because we're not in our high income earning years? And if we are in those years where we're in a 32% tax bracket for any income we generate outside of what they do on a day-by-day basis, right? So if their salaries alone are putting them there, anything we do from an investment management perspective, we need to try to be as diligent as possible, especially if we believe that they're going to be in a lower bracket when they retire. So it's this planning game and a technical analysis of, hey, where are they today? Where do we believe they'll be when they're retired or in the next 20 years? But anytime we're trying to be tax efficient and have the ability to do so, we will look at, first and foremost, probably a muni ladder is going to be where the tool where we can be most tax efficient. And so what I mean by that is munis, so municipal bonds, which I think of municipalities. If living in Arizona, if we buy Arizona munis, we not only get a state tax deduction for owning those munis, so any interest that it earns, we'll pay no state tax on, no local tax on. Munis are the only investment out there in the bond world where you don't pay any state, local, or federal taxes. So you have the ability to get tax-free interest. We'll build out a muni ladder. If we have a client living in Florida, we'll build out a muni ladder with all Florida munis. And ultimately, all of that interest is tax-free if purchased correctly. There's a few nuances there. Few
Mhm.
rules that I just say make sure you're talking to your financial professional or your CPA, but for the most part, tax-free interest. The only other caveat I'll add there on munis specifically is that muni income still gets put into the MAGI calculation, MAGI modified adjusted gross income calculation. So if you're on Medicare or you're worried about your IRMA premiums, Medicare premiums, the government has made sure that your tax-free interest from munis still gets included in your total income calculation for Medicare. So just FYI, it's not going to help you avoid or lower your Medicare premiums. It'll still bump you into a tax bracket if you're getting nice tax-free yield.
And like you said, depending on what state you're in, that might affect how we utilize some of those munis. If you're in a state like Minnesota with a higher tax bracket, that's going to be quite a bit more of a benefit than our Arizona flat 2.5 state tax.
That's a great point, Dylan. It really is. We built muni portfolios where, especially for Arizona clients, where they may not have all Arizona munis because the state tax isn't our biggest consideration or concern. If you're paying upwards of 30% or higher in the federal tax bracket, what's most important is you have a muni. The state, especially in Arizona, is such a low state tax, not as big of a concern.
And then one other thing that we see a lot of clients transfer in with current accounts is they might be in the 32% bracket. And just for some rough calculations here, if they're in a taxable bond earning about 7% interest a year, it might be more tax beneficial to buy a tax-free bond with a lower yield, paying 4 or 5. When you look at if you earned the 7% and paid taxes on it versus getting a lower interest per year and not paying taxes, that's the calculation we look at. So let's say if you get a tax-free bond at 7%, we'd have to be able to find a taxable bond paying over 10 and some change percent to where it starts making more sense for you to do that financially. So we can run those calculations, and it's really just important to look at. A lot of people overlook it and are leaving some tax benefit on the table.
That is another great point. And that's where, again, using your professional team and letting them do a tax equivalent yield analysis for you. Very quickly, you can find out like, hey, do corporates make more sense than munis? Or are munis outpaying corporates? And again, fixed income is a very intricate sector of the market. There's a lot more to consider than what's on the surface. You also have the quality of what you're buying. Investment grade bonds versus junk bonds. And even in the muni space, go bonds versus rev bonds, right? General obligation bonds, which is usually a little bit safer, considered a little bit more on the conservative of the muni side because it's the general obligation of the taxation power of that municipality. So versus revenue bonds, I'll use the example like if a bond was sold for the Arizona Cardinals Stadium, that is a revenue bond. The idea behind it is that the Arizona Cardinals need to generate enough revenue to pay back the bondholders for that stadium build. Just as an example, so there's a lot of intricacies to the fixed income space. There's a lot of intricacies to corporate bonds versus muni bonds. And so say use your tax professionals, but yes, there's definitely a lot of different investments out there that have different tax efficiencies or strategies you can put behind them that will help you with tax. Not to go on a whole nother diatribe, but even with dividends, qualified dividends versus ordinary dividends. So depending on what type of dividend the company pays, will depend on how that dividend gets taxed. So lots of intricacies. What I would say is this is where and why you have an advisor and a professional team.
Perfect. It is such an important tool to have your core professionals. We see typically it's your financial professional, your attorney, and your CPA or EA, depending on the case, working together. It does get you a better outcome in the long run. And so we're very happy to collaborate with those other professionals, and it ends up getting you the best treatment. Well, that wraps up this episode of the KDI Wealth Alchemist. We always encourage you guys to send any further questions that this might have generated for you or any topics that you'd like to see us cover down the road. We like to give a wide range from broad to pretty detailed spectrum. So give us some ideas, give us some topics, and we'd love to cover them. But hope you learned a few things today, and thanks for tuning in.